Hi, I'm Andy. Have you ever wondered what stocks AI would pick if you actually let it invest real money? Like, would it be a genius, a disaster, or somewhere in that chaotic middle ground where it claims to be 99% confident but still can't draw hands properly? Well, that's exactly what this challenge is all about. Every Friday after the market closes, I invest £10 into a UK-listed stock chosen entirely by AI. No overrides, no second-guessing, no human bias. Today, I'll walk you through the stock the AI selected for this week. And at the end, I'll reveal 3 things: the current value of this week's investment, the total value of the challenge so far, and the next stock the AI has chosen. So, what did the AI pick this week, and why? Let's jump in. Please be aware I am not a financial advisor, and nothing in this video should be taken as financial or investment advice. Everyone's situation is different, so please do your own due diligence and consult with a certified professional before making decisions. Investing always carries risk. Your money is never guaranteed, and you could lose some or all of your investment. To keep the challenge consistent, the AI uses the same structured prompt every week. It must choose a UK-listed company with strong financials, medium-term growth potential, no major red flags, and it can't pick the same stock again for at least 6 to 8 weeks. This keeps things realistic and stops the AI from shouting, "Buy Nvidia," every 5 minutes. It also avoids repetition. Well, most of the time. This week's stock is Halma plc, ticker HLMA. Halma is a global safety, environmental monitoring, and healthcare technology group. It owns dozens of specialized companies that make sensors, detectors, medical devices, and environmental analysis equipment. In the UK market, Halma stands out as one of the most consistent long-term compounders, a quiet overachiever that just keeps growing year after year. And yes, this is the second time the AI has picked Halma in this challenge. At a high level, the AI chose Halma because it's a steady, diversified, regulation-driven growth machine. Its products sit in sectors where demand doesn't disappear overnight: safety, healthcare, environmental monitoring. It has recurring revenue, strong margins, and a long history of compounding earnings. And in a medium-term window like 6 to 24 months, stability plus growth is exactly what the AI looks for. All right, here are the headline numbers the AI looked at this week. Halma sitting on a PE ratio of around 40 times, an APEG ratio that ranges between about 1.6 and 3.2, depending on whose forecast you use. Revenue is still growing nicely, roughly 15% year-on-year. EPS is moving the right direction too, up 21%. Debt looks comfortable, with net debt to EBITDA at about 1.16. Cash conversion is strong, roughly 68%. And free cash flow? Well, that is around £426 million. Nice steady numbers across the board. So what do these metrics truly mean? The PE ratio tells us how much investors are willing to pay for each pound of Halma's earnings. And at this level, it shows the market sees Halma as a quality company. Think of it like paying extra for a tool that never breaks. You're not buying cheap, you're buying reliable. A higher PE isn't automatically good or bad. It simply means expectations are high, and Halma has earned that trust over many years. The PEG ratio helps us understand whether that high PE is justified by growth. A PEG between roughly 1 and 3 suggests Halma's growth outlook still supports its valuation, even if it's not a bargain bin stock. Imagine a runner who isn't the fastest, but never slows down. The PEG shows Halma's pace is steady enough to justify the price tag. Revenue growing around 15% tells us Halma's products are in demand across safety, healthcare, and environmental monitoring. This isn't hype growth. It's the kind that comes from regulations, long-term contracts, and essential equipment. Picture a rising tide lifting a fleet of small specialist companies. That's Halma's group structure at work. EPS rising 21% shows the company isn't just selling more, it's becoming more profitable. It's like a factory that not only produces more widgets, but does it more efficiently each year. Strong EPS momentum is one of the clearest signs of a business that compounds over time. A net debt to EBITDA around 1.16 times means Halma's debt is modest relative to its earnings power. Think of it like carrying a small backpack on a long hike. Noticeable, but nowhere near heavy enough to slow you down. This gives Halma flexibility to acquire new companies without putting strain on the balance sheet. Cash conversion in the high 60s means Halma turns a large chunk of its profits into real, usable cash. Imagine profits flowing through a pipe. Some companies leak along the way, but Halma's pipe is tight and efficient. Strong cash conversion is a hallmark of disciplined operations and predictable financial performance. Free cash flow of over £400 million shows Halma has plenty of financial firepower. This is the money it can use to invest, acquire, innovate, or return to shareholders. In whiteboard terms, it's the fuel tank that keeps the whole machine running smoothly. 8 weeks ago, Halma looked like a high-quality compounder with strong cash generation and low leverage. Today, it still looks like a high-quality compounder with strong cash generation and low leverage. The metrics have shifted slightly. PE has eased from around 45 times to roughly 40 times. Cash conversion normalized from 79% to approximately 68%, and net debt to EBITDA nudged up from about 1 to about 1.16 after acquisition activity. But the story hasn't changed. Halma continues to deliver steady growth, strong margins, and reliable cash flow. The AI picked it again because Halma remains one of the strongest medium-term profiles in the UK market. And sometimes the best stocks are still the best stocks 8 weeks later. So, how many shares did my £10 buy? At the time of purchase, the share price was £39.82. That means I bought just under a quarter of a share. And right now, at the time of recording, well, the value of that investment along with the fifth of a share I bought 8 weeks prior is just £17.04. Now that is approximately a 14.4% or just under £3 loss. Alright, let's talk about the elephant in the portfolio. The market's been wobbling lately. Geopolitics, inflation jitters, interest rate noise, you name it. And yep, that means some of these stocks, including Halma, have taken a hit. Now, if you look at the charts on screen, you'll see Halma's price dipping like a roller coaster that forgot the safety bar. And the FTSE 100? Well, similar story, just with 99 other passengers to smooth the ride. Here's the thing. This happens. Markets breathe in and out. Sometimes they sprint. Sometimes they sulk. It's not a glitch. It's the rhythm of investing when prices fall. It's easy to panic, to think, should I sell? Should I change the plan? But remember, this challenge was never about quick flips or day trading drama. From the start, it was a medium-term strategy, 6 to 24 months, built on discipline and data. Having a plan means you expect turbulence. You strap in, you trust the process, and you let time do its thing. There's nothing wrong with reviewing or even selling when your plan calls for it. But this plan doesn't. This plan says, trust the AI, trust the horizon, and keep going. So yes, the numbers are down right now. But that's part of the story, not the ending. Every investor faces red days. The trick is not to let them rewrite your goal with sticking to the plan. Medium-term outlook, eye-driven picks, and a healthy dose of patience. Because sometimes the smartest move is simply staying in your seat while the roller coaster resets for the next climb. Here's the updated AI challenge pie, showing how the fund is split and how the challenge is performing so far. As always, investing carries risk. Prices can go up or down. The total value of the challenge is currently £98.37, which means an overall loss of £1.63 since we started. But remember, this challenge is about the medium term, not quick wins. We're here to see whether AI can build a solid, diversified portfolio over time, and really, given the recent losses on the markets, it has weathered the storm rather well. To keep things diversified, the AI won't pick London Stock Exchange, Auto Trader, RELX, Rolls-Royce, Computer Center, Sunbelt Rentals, Currys, or Halma again for at least 6 to 8 weeks. And now, the moment you've been waiting for. The AI has already chosen the stock for next week. And that stock is AstraZeneca. We'll break that company down in the next week's video. If you want to follow this challenge week by week, make sure to like this video and subscribe. Also, feel free to leave any comments. I'd love to know your thoughts and what you'd like to see in the future. If you want to see any of my other videos, check out the ones to the right of this video now. The bottom one is the one YouTube thinks you may like to watch next. See you next time.